Let's start with the basics. What exactly is a stock? A stock represents ownership in a company. When you buy a stock, you're essentially buying a small piece of that business. This means you become a shareholder, giving you a claim on part of the company's assets and earnings. Stocks are often referred to as shares or equities, and owning them can be a way to participate in a company's success. Understanding this fundamental concept is the first step to navigating the world of investing and the stock market. When you own shares, you're known as a shareholder. This status comes with certain rights, such as voting on important company matters and receiving dividends if the company distributes profits. Shareholders are crucial to a company's structure, as they provide the capital that helps businesses grow. The more shares you own, the greater your influence and potential rewards. Being a shareholder is about more than just owning a piece of paper. It's about having a stake in the company's future. Companies issue shares primarily to raise capital. This influx of funds allows them to expand operations, invest in new projects, or pay off debts. By selling shares to the public, companies can access a large pool of money without taking on loans. This process is especially important for growth and innovation, enabling businesses to reach new heights. Issuing shares is a strategic move that benefits both the company and investors looking for opportunity. The first time a company offers its shares to the public is called an initial public offering, or IPO. This is a major milestone for any business, marking its transition from private to public ownership. Through an IPO, companies can raise significant capital and increase their visibility. For investors, IPOs present a chance to get in early on a company's growth journey. However, IPOs also come with risks, as the company's future performance is often uncertain. Stocks are bought and sold on stock exchanges, which act as marketplaces for these transactions. Famous exchanges include the New York Stock Exchange and NASDAQ. These platforms ensure that trades are conducted fairly and transparently. Stock exchanges play a vital role in connecting buyers and sellers, setting prices, and maintaining market order. Without them, investing in stocks would be far more complicated and risky. Stock prices are constantly changing, driven by the forces of demand and supply. When more people want to buy a stock than sell it, the price goes up. Conversely, if more people want to sell, the price drops. This dynamic reflects investor sentiment and expectations about a company's future. Understanding these movements is key to making informed investment decisions and recognizing market trends. Stock prices increase when investors believe a company will perform well in the future. Positive news, strong earnings, or industry growth can all boost demand for a company's shares. As more people try to buy, the price climbs higher. This optimism can be contagious, leading to further price increases as more investors jump in. However, it's important to remember that prices can also be influenced by speculation and market trends. On the flip side, stock prices fall when investors lose confidence in a company. This could be due to poor financial results, negative news, or broader economic concerns. When more people want to sell than buy, the price drops. Sometimes fear or uncertainty can cause sharp declines, even if the company's fundamentals haven't changed much. Understanding why prices fall helps investors manage risk and avoid panic selling. Several factors influence stock prices. Company performance, such as profits or losses, is a major driver. Economic conditions, like growth or recession, also play a role. Interest rates and inflation can impact how attractive stocks are compared to other investments. Additionally, news events and global developments can cause sudden price swings. By staying informed about these factors, investors can better anticipate market movements. The stock market is made up of different participants, each with their own goals. Investors typically buy and hold stocks for the long term, aiming for steady growth. Traders, on the other hand, seek short-term profits by buying and selling frequently. Brokers act as intermediaries, helping buyers and sellers complete transactions. Understanding these roles can help you decide which approach best fits your financial goals. Investors and traders have different strategies. Investors focus on the long-term potential of a company, often holding shares for years. They look for steady growth and may receive dividends. Traders, however, try to profit from short-term price movements, sometimes buying and selling within days or even minutes. Both approaches have their pros and cons, and choosing the right one depends on your risk tolerance and financial objectives. There are two main ways to earn money from stocks: capital gains and dividends. Capital gains occur when you sell a stock for more than you paid. Dividends are regular payments some companies make to shareholders from their profits. Both methods can help you grow your wealth, but they come with different risks and rewards. Understanding these earning opportunities is key to building a successful investment strategy. Investing in stocks isn't without risks. Prices can be volatile, sometimes swinging wildly in short periods. Market crashes, though rare, can wipe out significant value. There's also the risk that a company could fail, making its shares worthless. Being aware of these risks is essential for every investor. The key is to manage them wisely and not let fear dictate your decision. Smart investors use several strategies to manage risk. Diversification means spreading your investments across different companies and industries, reducing the impact of any single loss. Doing thorough research helps you make informed choices. Adopting a long-term strategy can also smooth out short-term ups and downs. By combining these approaches, you can protect your portfolio and increase your chances of success. The stock market plays a vital role in the economy. It helps companies raise funds for growth, which leads to job creation and innovation. For individuals, investing in stocks can be a powerful way to build wealth over time. On a larger scale, a healthy stock market supports economic development and prosperity. By understanding how the market works, you can make informed decisions and contribute to economic progress.